In my opinion, these are the top 5 ETFs that could be a cornerstone investment for any long-term investor. Let's get right into the video. Hi guys, welcome back to another video. My name is Josh, and I know that there are currently a lot of fund providers out there, and deciding on which ETF to buy can be a little confusing. So I thought in this video, I'll go through what an ETF is, the advantages and disadvantages of investing in ETFs, and I'll also show you 5 of the ETFs that I've researched that I personally think are the best ETFs for long-term investors. I'll go through what these ETFs hold, what type of fees they charge, as well as potential alternatives to these ETFs to suit your own situation. The best type of ETF for an individual will depend on the individual's age, risk appetite, investment horizon, and investment goals. Therefore, this video is purely for entertainment purposes only. It's not financial advice, as it might not suit you. And if you do need help with these products, do seek help from an authorized financial advisor and do your own research before investing. Okay, so without further ado, let's get right into the video. An ETF is a basket of assets designed to track an index. A market index is a hypothetical portfolio of investment holdings that represents a segment of the financial market. So for example, the NZ 50 represents the 50 biggest companies listed on the New Zealand Stock Exchange. The ETFs that I'll be talking about today will mainly relate to shares in companies, as well as real estate investment trusts, or otherwise known as REITs. In this video, I won't be going over more thematic ETFs, as these are more specific in nature and might not suit everyone. So very quickly, let's just go through the advantages and disadvantages of an ETF. Firstly, ETFs are very cost efficient. They charge lower fees compared to managed funds, which means that you keep more of the returns. Secondly, ETFs are a source of diversification, as buying an ETF will mean that you own numerous stocks. In terms of disadvantages, you cannot change the stocks of what the ETF holds. A reason why an investor might want to do that could be due to moral hazards, such as avoiding particular industries such as the gambling industry. Another disadvantage is that ETFs usually underperform the market after fees because by nature they are designed to track the market index. If you're looking to outperform the market, ETFs might not be the right product to do so. So at the end of the day, it all comes down to your investment goals. So the first ETF that we'll be talking about today is the NZG fund provided by Smartshares. And this ETF is designed to track the return on the S&P NZX 50 index. The index is made up of 50 largest companies on the NZX main board. The weighting of each of the 50 stocks are based on its market capitalization. The NZX 50 has a high weighting towards utilities and telecommunications. For example, Spark New Zealand Limited, Meridian Energy, Contact Energy, Chorus, and Infratil. The top 2 stocks, Fisher & Paykel Healthcare and A2 Milk, makes up 30% of the ETF. What this means is that the performance of this ETF is largely dependent on the performance of Fisher & Paykel Healthcare and A2 Milk. If Fisher & Paykel or A2 Milk don't perform well, then this will cause a drag on the fund performance. In my personal opinion, I think the level of diversification here is low to medium and is better suited for investors with a longer investment horizon. In terms of the fund performance and the dividend yield, it is currently showing as 0 because this NZG fund is a new fund. It has only been created in July 2020, so there's no track record of returns and dividends yet. The fund charges are 0.2%, which is one of the lowest fees at the moment. Overall, I think this is the best low fee fund that tracks the NZ stock market with low to moderate diversification. You might want to consider alternatives to the NZG fund, and these are the FNZ Smartshares fund and the Simplicity NZ Share fund. All of them track the S&P NZX 50. However, the Smartshares FNZ fund has each individual stock capped at 5%. What this means is that you'll have a higher level of diversification in the FNZ fund compared to the NZG fund. The FNZ fund has a fee of 0.5%, and the Simplicity NZ Share Fund has a fixed fee of $20 per year plus 0.1%. So I've done the calculations for you. If you have more than $20,000 to invest, then you'll pay less fees with the Simplicity NZ Share Fund. In terms of the dividend yield, NZG Fund, as I mentioned before, hasn't had anything, so I put an NA there, but we can expect that the dividend yield will be very closely aligned to FNZ Fund, which currently pays 3.52%. Furthermore, the NZ Simplicity Fund doesn't pay any dividends. All of the dividends get reinvested. So if you do want a dividend, you can sell part of your shares in the share fund and withdraw that and manufacture your own dividend. Moving on, we have ETF number 2, which is the Kernel NZ20. This fund tracks the NZX20, which is the 20 largest companies in New Zealand. This fund has returned 16.36% for the past 10 years, which is absolutely incredible. Going forward, I don't expect to see this type of returns because 16.36% is much higher than the averages of these returns provided from indexes. And in terms of the dividend yield as at 31st July 2020, it's 2.98%, which is very reasonable. In terms of the holdings, it's very similar to the NZ50 fund. In fact, the top 5 shares make up 52% of the fund. Now, in the link down on the right-hand corner, it is actually a blog post from Kernel. And in that blog post, they mentioned that Kernel believes the NZ20 is better than the NZ10 because of numerous reasons. After all, the NZ20 has outperformed the 50 in the past 1, 3, or 5 year time horizon. They mentioned that a possible reason for the outperformance is that the top 20 are well covered by foreign analysts and meet investment criteria of offshore investors. Personally, another reason why I think the NZ20 has outperformed it is because it is weighted towards companies that have benefited from the lower interest rates such as utilities and telecommunications. So there are a few compelling reasons why you might want to invest in the NZ20, but do bear in mind that the NZ20 does have a lower level of diversification compared to the NZ50. So the fee structure for the NZ20 is the same across all funds within the Kernel platform. If you have a portfolio value of over 25,000, then you will pay a 0.29% fee. Portfolios below 25,000 will be 0.39%. In addition, there is a monthly member fee of $3 per month if your account is 1,000 plus. In summary, the NZ20 fund provided by Kernel is the best low-fee fund if you want to invest in the NZ20. And again, I'd like to remind you guys that no one knows if the NZ20 fund will continue to outperform the NZ50, but there's definitely good reasons to believe why they might. The third ETF that I'll be talking about today, that is the NZ Commercial Properties Fund provided by Kernel. The Kernel NZ Commercial Property Fund invests in 8 listed real estate investment trusts who own and manage commercial property portfolios. They have returned a 13.31% gross return before fees and taxes and pay out a regular income stream of 4%. In terms of their holdings, they have REITs spread across different types of real estate. So for example, office, retail, industrial, and healthcare. In terms of the fee structure, this is the same as the NZ20 because Kernel has the same fee structure for all their different funds. So I'll spare you guys and not repeat myself. If you'd like to know more, you can go back to the NZ20 section. Alternatives to the Kernel property is the Smartshares Property ETF fund. They track the same index, which is the S&P NZX Real Estate Select, and their annual fees are 0.54%. So I've run the calculations, and if you have less than 24,000 to invest, then the Smartshares Property Fund is more worthwhile because you'll be paying lower in fees. But if you have more than 24,000, or if you already pay the membership fee with Kernel because you have other funds with them, then the Kernel platform is a better choice here on a fee basis. Next up, we have the fourth ETF on this list, which is the Australian Shares S&P ASX 200 ETF. This fund is designed to track the returns of the ASX 200 index, which makes up 200 of the largest companies on the Australian stock market. This ETF only has one holding, which is the iShares ASX 200 ETF. So when looking at the underlying holdings, I went to the iShares website and this is what I found. The ASX 200 is heavily weighted towards financials and materials. This provides exposure to industries that are underrepresented by the earlier New Zealand index funds. Again, the gross dividend yield here is 0 because this is a new fund that was created in July 2020, so there's no track record of returns or dividends yet. The underlying performance of the ASX 200, the 5-year return is 7.2%, which has lagged the New Zealand funds. However, if you do want exposure to Aussie or industries like banking and finance, then this is definitely a good option. And also the fund charges here are 0.3%, which is one of the lowest fees at the moment. So that is the Aussie 200. The last one that I have here on this list is the Kernel S&P Global 100 fund. This fund has a 5-year annual return of 13%. And has a large tech exposure. And you can see that their top 5 holdings are actually US tech firms such as Apple, Microsoft, Amazon, and Google's parent company, Alphabet. So I like this fund because it adds another layer of diversification as well. You can see here that 72.9% of this fund is invested in the US. What this means is that it adds another layer of diversification in terms of currency exposure. Because your investments are held in US and are denominated in US dollars, a fall in the NZD against the USD will increase the value of these investments. There is a lack of tech companies on the NZX, so this fund will give you exposure to tech. The fees for the Kernel Global 100 fund is the same as all other funds on the Kernel platform, so I won't repeat myself here. However, looking at the alternatives, the only alternative that I can really think of is the Vanguard International Shares Select Exclusions Index Fund. The index that the Vanguard fund tracks is the MSCI World, excluding Australia, excluding tobacco, excluding controversial weapons and nuclear weapons. The annual fees is 0.2%, so as you can see, it is slightly lower than the Kernel Global 100. But what I do like to mention is that if you go with the Vanguard fund, then you have to worry about FIF taxes if you have over $50,000 to invest. The Kernel fund does have a higher weighting towards tech, and tech has done really well in the past 3 years. If you think tech stocks will continue to have room to go up in the future, then the Kernel 100 will probably outperform, otherwise the Vanguard might be a better option. However, I am a little bit apprehensive about the Vanguard fund because if you do go over the 50,000 threshold, then you do have to worry about the FIF tax rules. Furthermore, the Kernel Global 100 fund actually owns all the underlying stocks within the fund. And what this means is that they're able to claim tax benefits from the other countries that they have tax treaties with. That might not necessarily be the same case as the Vanguard fund, but you know, if you have less than 50,000 and you're nowhere close hitting that $50,000 mark, then the Vanguard index fund might be a better option because of the lower fees. Again, depends on your own situation. That's why I am not giving financial advice, purely for entertainment purposes only. So this rounds up the top 5 index funds that I think could make cornerstone investments for a long-term investor. Let me know in the comment section down below which funds you're invested in. And if you enjoyed this video, be sure to like and subscribe. Until next time, guys, take care.